Good morning, my name is Stagflation. I'm Chief Economist at the XTB and you're watching weekly trading webinar. Today we'll discuss mostly about gold prices. Gold prices have been somewhat lackluster for quite a bit of time. There were somewhat contrasting signals affecting the market. On one hand, we still have very expansive monetary policy, which is normally seen as positive for gold. However, on the other hand, we also have very strong dollar, and we recently we had rumors and to some extent confirmed by the Fed that the QE program in the US might be unwound in months to come. So what's gonna happen with gold prices? When will gold rally return? This is the story of the week. However, traditionally we also have other stories, and we'll start from what's hot on Monday morning. So I think the biggest topic for the markets these days is energy crisis, which started, by the way, in UK, in Europe, now seems to engulf most of the world. And because obviously the world is one global economy and markets are interconnected, it very quickly can spill over from place to place. The most serious symptom of how bad it is for the markets has been a call from the Chinese officials for local governments to secure energy supplies for winter at any cost. So obviously this is not going to help things. This is going to only increase the pressure on energy commodities, and it looks like we are more and more dependent on winter weather. If it's going to be freezing, if it's going to be very cold, then it might be really challenging, not only for the prices, but also for the global economy, which we'll discuss in a minute. In this context, it will be very interesting to hear from the OPEC, because obviously, even if oil prices are not the key determinant of this energy crisis, then obviously it's a part of it. If we look at oil prices on the chart, we can see that they have returned to the bull rally after some correction that we witnessed over the summer, where there were concerns about this Delta variant in the US. Let's take a look at this. Yeah, here it is, this correction I was talking about. But then quickly oil prices recovered, and now they are trading at multi-year highs. So obviously we're still far off from the places before the shale revolution in the US, but looking in the context of the last couple of years, we are really at the very elevated levels. And obviously global markets would love to see oil prices at least stabilizing or preferably going lower. But will the OPEC bend to these demands? I'm not really so sure. Why would they, transfer these benefits they can get from themselves to the other participants of the market? I think they will only act if they think that these high energy prices may destabilize global economy. So there is a talk of extra at least 500,000 barrels demand per day because of this energy crisis, but I don't really think OPEC meets this higher demand with supply one-to-one. Maybe they will accelerate the increases in supply slightly, but I don't think this will make a huge difference. Then the other story that rattled markets over the past few weeks was Chinese Evergrande, huge developer, the biggest debtor in China, which is on the brink of default. And while the official default is not yet there, because even though the Chinese developer, they didn't pay interest on US dollar bonds, but there is 30-day grace period. But it seems like the government is going for a structural restructuring, we can say so. So we'll see if the company survives. Maybe it's trimmed down very significantly at least for now, it seems like this call for other entities to buy assets of the firm so they can pay off debt and at least stave off the default scenario. It's unfolding because today we get the news that they sold a very substantial unit for more than 5 billion of US dollars. So at least for now, it looks like it will not be on top of the market agenda. However, obviously, broader ramifications are still there, especially with this energy crisis already causing stoppages in Chinese factories. Then key events this week, we have a lot of important macroeconomic data from the US. The US economy has recently shown some signs of slowdown and deterioration, with the ISM manufacturing on Friday being one of the very few positive surprises. However, not necessarily a game changer. Here, as you can see, the peak probably was there a few months ago, and we could be on this downward trajectory from there. But this week will be very, very important for the markets. We have the NFP on Friday, and this could seal the deal for the QE wind down from November. So markets will be really looking forward to it. We'll discuss this at the end of our presentation. So very quickly, before we go to the gold prices story of the week, let's discuss this energy crisis and what it means for the markets. So as you can see here, obviously, natural gas and energy prices in Europe are skyrocketing. That doesn't help things. That's mostly because this green push means that there is less instant supply of what you can get from traditional sources, especially coal. And now, a couple of really things that came together at a bad time, like this less wind in UK, lower water levels in Norway, strong demand because of this fiscal impulse, and yeah, some worse weather, Russia policy, and a couple of those things together suddenly means that there is a deficit of energy commodities. And why is it is bad for a global economy? Not only, it's obviously what you see is electricity prices, prices at the gas pump and things like this, but this could be temporary, right? You could see improved weather in a month, let's say, and this will go away. But what's more important is how it affects global economy in a more structural way. The policies that governments and central banks implemented in 2020 and which were continued this year, they were about pumping up the global economy with a huge intervention, which obviously increased public debts, which was possible due to this unprecedented money printing. And what they hoped for was that this strong demand will revive the supply side of the economy, and then the economy will shift up the gear and just roll over from there. And obviously, even before this energy crisis, there were symptoms that this is not going to be that sweet because of different constraints. The supply side was unable to meet demand, and instead of rising up because it was impossible, they started rising prices. So obviously it meant a problem for central bankers because suddenly, the scenario was not so good, and with higher price levels and higher inflation, they are cornering themselves into a situation that they could be forced to tighten monetary policy just when the economy is slowing down. And obviously now here comes the energy crisis, and it makes this picture so much worse because obviously with these higher prices and with shortages like we already had in China, you will have even less output, because if you have a stoppage, if you have higher costs, then obviously it affects output in a negative way, and even more price pressures. So central banks are even more in a corner, and suddenly it looks like they really need to pray for a warm winter, because if there is a cold winter and if this situation persists, then we can really have a stagflation scenario, and this could be much more serious. Because as you can see right now, if you look at the global markets, they reacted in a way to all those things: energy crisis, Evergrande, the Fed signaling finish of their QE policies. But I wouldn't say there was there was a very huge reaction, and there were certainly attempts to rebound from these sell-offs as the buy the dip mentality remains extremely strong. However, if you look at especially the DAX, which seems to be, you know, we discussed this over the past few months, signaling that this is the weakest of the major global indices, and you can see that there is some kind of, you know, topping out, right? Kind of, you had a very strong upwards channel for months, and then, you know, the index, you know, they were still making new highs, but at the very low pace, and suddenly, you know, we have a reversal. This is not yet decisive, this is not yet very strong, but you can see that the demand is weakening and weakening, and even US markets, which were much stronger, you can see at the Nasdaq, and we are at the lower limit of this very aggressive upwards wedge, and obviously we are still between buying the dip mentality, which, as I said, is still very, very strong. There is still a lot of money on the market, and, you know, all these worries. So I think there is a increasing possibility of something boiling over, and, you know, causing a major dip here. So we'll see, but I think the risk is certainly on the right. So how does gold look like, and the outlook for it in this context? So let's start from a little bit background, and let's see what went wrong for gold following the crisis last year. If you compare gold prices to what happened in 2009 and next few years, there was a tremendous rally, and initially this rally that started in March 2020, it looks similar. We had very strong rebound, we had a lot of QE, so there was a talk, well, we could have a repeat of this, but this hasn't really come into fruition. So what went different is that everything was very, very compressed compared to the situation that we had more than a decade ago. So back then the recovery was slow, and even though there was a QE, it wasn't as huge as it is now, and you can even recall that it took S&P 500, I think, 4 years from the crisis to return to the previous highs, whereas now there was just few months, and very quickly we found ourselves in a situation where we had a lot of price pressures, and we had a discussion, even if it didn't end up with some action, we are still waiting. We had some discussion about withdrawing the monetary stimulus, and I think this is something that made this situation different from what we had back in 2009 and next few years from there. And right now we are in a situation where we still don't have a 100% declaration from the Fed what they're going to do in November. However, if you listen to Powell and himself being upbeat on unemployment, on economic growth next year, it looks very likely that they will start unwinding the stimulus. And if you compare this to the historical situation, you can see that the so-called taper tantrum in 2013, it was very bad for gold prices. It was announced by Bernanke here, and as you can see, it only made this bear market deeper. Another situation worth noticing is 2018, where we had a combination of economic slowdown and monetary tightening, something that, as I already mentioned, we could see a kind of a repeat of it. Obviously the situation is different, but we could see a situation where the Fed reduces their QE, and at the same time economy starts slowing down. So this is what we had in 2018, and still wasn't very favorable. And the third situation is in 2019, when the Fed realized that the economic outlook is not as bright as they hoped, and they reverse the course and start cutting interest rates. So obviously they will not cut interest rates next year, because they will not be able to rise them in the first place, but they can reverse the tapering that they are very likely to start next month. So until now, what I showed you last week, markets had very comfortable situation where most of the debt, net debt issued by US Treasury was really bought up by the Fed. So there was a lot, and there still is a lot of liquidity, because obviously this money doesn't need to be drained from the market. But this is going to change. Even if there was no tapering, we would still see a much higher debt placement starting probably towards the end of this month, if the debt ceiling is raised, and it needs to be raised. But if you add tapering to this, suddenly we are looking at the prospect of many months of liquidity drain. So this is obviously not good for all the markets, but it definitely is not good for gold, because it could push bond yields higher, at least until the moment when markets realize we are in the slowdown, and obviously higher bond yields, and possibly also stronger dollar, although dollar is already strong and it's actually at a very, very crucial support level here. But you know, with the prospect of the tapering, and with the no prospects of sudden bigger monetary change in Europe, it's, you know, this support doesn't look really convincing to me. And if they break it, if they are unable to hold on here, obviously you can see nothing here. So obviously this is another risk for gold markets. Then if you look at the chart which I showed you a few months ago, when I stated that I was no longer that positive on gold, you could see that gold prices actually moved lower more than the bond yields would indicate. So you could see this as a positive. However, again, in 2013, when we had this taper tantrum, you could see that the situation was similar, and still both markets moved in tandem for a while. So this is still very possible that we have bond yields rising and pushing, with a strong dollar, pushing gold prices lower in a medium term. And finally, if you look at the longer term deviation from 200s day average, you could see that we are still close to the average. So the market is no longer overbought, but it's neither oversold. So this is also, I think, something to bear in mind. And to conclude, I think if you look at gold, you want to watch this 1680 support, because it helped market to revive already 3 times. So I think if we are there, if the demand shows or close to this, like 1700, and demand starts trying to pick up, I think this is a good opportunity for speculative rebound. However, for the longer term, and if you're looking for a sustainable rally, I think it would be better to be in a situation where the Fed is already throwing up the towel about the QE tapering, because they realize the economy is not as strong as they believe to be. Before that, we could actually see either a consolidation or even a downward trend, and a possibility of breaking lower here. Okay, so let's move on to this week, and as I said, it's going to be all about the NFP that we have on Friday. This report is so immensely important, because the Fed already signaled they want to start tapering, and they need a final, proof that this is the right decision. And as you can remember, the NFP in August was very weak. So the market obviously thinks it's going to reverse, because if you look here, there is a lot of volatility in the data, and because of the weak report a month ago, the consensus is relatively low. It's at 500,000, so it's lowest since February, and with special benefits in many states already gone, it is possible that we could actually have a relatively strong month this time around. Interestingly, markets actually would like to see, I would say, relatively mild report, because if the report is strong, it will seal the deal, the dollar will strengthen, bond yields will rise, and the worries will only intensify. So I think a very strong report is the worst case scenario for the markets, but of course the best scenario for the US dollar. Then the whole week will be like waiting for this NFP, because we have ISM services tomorrow 4 p.m. CET, which is 3 p.m. GMT. And this will be very important because obviously 85% of private employment is in services. And this employment, in contrast to manufacturing, it was relatively strong. So this report shows that if we get another relatively high bar, this blue bar here, tomorrow, then it could be a good indication for the NFP on Friday. And then we have the ADP on Wednesday. The ADP report is private assessment of the private employment in the US economy, and you could actually argue that it's more stable than the NFP. But from month to month, there could be quite serious differences. However, last month the ADP was relatively weak, and then indeed the NFP was weak as well. So these two reports are certainly to watch this week. Okay, ladies and gentlemen, thank you for your attention. Please read our news section in Xstation mobile applications, where we will report all the market developments. We'll comment these reports from the US and more. And I see you next week on Monday.